there you have it, your closing bell for July 7th. Let's take a look at how the major indices ended the day, as you can tell from the cheering actually being reflected in the performance today in the major indices. All three ending in positive territory, touching session highs as they accelerated into the close. The Dow up more than 1%, up 343 points. The S&P 500 up about 1.5% there, gaining about 57 points. And the Nasdaq, the tech-heavy Nasdaq, the big winner of the day, about 2.33% there, up almost 260 points. Let's break some of this down now with our market guests. Joining us now is Mahmood Noorani, Quant Insight CEO, and Jim Caron, Morgan Stanley Investment Management Fixed Income Portfolio Manager. So Mahmood, starting with you, what are you sensing about the sentiment in the markets right now based on today's performance?
Well, as it has been for a while, it remains about the Fed. We have seen the market take out around 0.5% of Fed hikes next year. And the reason they've done that is because there's a bit more optimism on inflation coming down. 5-year US inflation expectations are now trading with a 2% handle. They're around 2.9. And the reason inflation expectations are lower is because there's a lot of talk about recession. And indeed, US data is pointing to a softer US economy. And we've seen some falls in commodity, agricultural, and energy prices. So it really is the one game in town. It's to do with the Fed, and the market's getting optimistic that the Fed may not have to hike as much as they thought previously.
And Jim, no real surprises from the Fed minutes yesterday. So when you look at today's performance up across the board and the small caps up 2.3%, what to you is driving the markets?
Well, it seems that the further we go along here, the Fed's going to become more data dependent. So I think the Fed is on a mission to get their policy rates up to at least 3.5% by the end of this year. We'll see if they're going to be able to do that. If something breaks along the way in the economy or in the markets, then they may not be able to. But the point of the matter is that once they get through July, which we expect 75 basis points, in September, where we expect another 50 after that, then I think it becomes a much more data dependent Fed. So depending on what's going on in the broader economy, it's going to suggest that, rates, it's going to really determine what the terminal value of the Fed funds rate might actually be. The one thing that I'll say, though, is I call this a triple D economy. It's demand destruction by design. The Fed is trying to slow down growth to bring down prices. And to the extent that they can bring down prices and control inflation, then the less they need to hike rates in the future. But at this point, it's probably premature to say that the Fed is anywhere near being done.
But Jim, what drove sentiment today? It's hard to keep track of these ups and downs and the volatility. What drove it today? We've known all this. This has all been priced in, the stuff you're talking about from the Fed. Yeah,
so I think today it was really just a relief from what we saw over the past few days. I mean, the fact that 10-year Treasury yields yesterday at one point got down to 2.75% is, to me, is pretty crazy. So I think from today's perspective, the markets are starting to probably breathe a little bit of a sigh of relief to the extent that, we have CPI coming out next week. That might represent the peak in inflation. People are still hopeful of that. There's a lot of debate around that. And if that's the case, and if inflation does start to make its way lower, then I would argue that this becomes a little bit more friendly to the markets. And I think maybe that's what the markets were sniffing out today.
And Mahmood, where are we in terms of the preference for value versus growth stocks in this cycle?
Well, it's interesting. I was looking at your market summary, and we can see that growth has outperformed value for the last couple of days. And that's simply because financial conditions are easier. What's driven the whole value growth connection over many months now is financial conditions. When real rates rise, value outperforms. When you get QE and zero rates, growth outperforms. And that's because in the world we live in today, growth and a lot of tech are very dependent on financing. So a lot of that is driven by financial conditions. And so as we see the market take out and get optimistic about where the Fed will end and reduce the terminal rate, as we've seen over recent days, that's the cue for growth to outperform a little bit.
Jim, you referenced the CPI number, which I think we get the 13th. Some expect that number to go up as high as 8.8%. You say there are three types, though, of inflation, only one which the Fed can really have much impact. What is that, and do you think the print will go up?
Yeah, so the three types are food inflation, energy inflation, and wage inflation. And the Fed is really trying to impact wage inflation. They can't do anything about the first two. Wage inflation is what is most important, because this is what really gauges the inflation expectations and inflation psychology, and it creates what we call this wage price spiral. And the Fed is trying to break that linkage right now. So the issue, though, is that if we looked at the JOLTS data that came out yesterday, the labor market's still very, very strong. And this may be, I would argue, this could be the last very strong monthly print on payroll. So in other words, the market's expecting 265,000. Morgan Stanley's estimates are a little above 300,000 for that, for the number. But then after that, we may start to see numbers that are sub 200,000. But those are still very, very strong numbers for the labor market. So what the Fed needs to try to do is bring down demand enough and unfortunately hurt the labor market to the point where it increases labor supply coming into the market, so more layoffs therefore, and that ends up bringing down inflation. And that's really that's a part of the story that the Fed doesn't really like to talk about, but that's what is going to be required based on the Fed's playbook to bring down inflation. They have to control wage inflation.
And Mahmood, then with that in mind, then obviously during the press conference that Powell had, someone specifically asked him, does the Fed want to have a recession, pretty much sort of get it out of the way by making sure that employment does sort of creep up slightly tight in this tight labor market? What's your take on how the Fed will proceed from here based on what you saw in the minutes and based on some of the data expectations ahead?
I totally agree with Jim's points earlier that the Fed has to try and reduce demand and destroy demand, and the channel they're working through is to weaken economic activity and to try and make a dent in the labor market to bring wages down. My read of the Fed and the minutes and recent statements is relatively hawkish. I think the market's getting a bit over optimistic at the moment. And I think you have to take into account that the Fed came in for a lot of criticism for probably being far too late in raising rates. That meant they had to go more aggressively. And probably the last thing they want to do now is, again, be too slow. So if anything, they'll probably err on the side of being a bit more aggressive than, too slow.
We do thank you both for your insights. Mahmood Noorani there, Quant Insight CEO, and Jim Caron, Morgan Stanley Investment Management Fixed Income Portfolio Manager. Thank you both.